Midweek check-in. Today is April 22nd, 2026. I'm Patrick, broadcasting from Vancouver. Midweek, let's reassess this week's positions and look for fresh setups. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. The AI complementarity framework is emerging as a powerful way for software companies to protect their valuations instead of fearing total disruption. That is the reason investors should keep listening today. Markets opened higher in pre-market trading but closed mixed. The S&P 500 closed at 7,064, down 0.6%. The NASDAQ Composite closed at 24,260, also down 0.6%. The TSX Composite finished at 33,808, down 1.6%. Our simulated portfolio stands at year-to-date negative 0.38% versus the NASDAQ Composite year-to-date positive 4.41%, delivering year-to-date alpha of negative 4.79%. About 15 days ago, we picked SSNLF on an AI memory chip demand thesis that closed flat. This illustrates that even clean catalysts still need sustained buying pressure to generate alpha. With ships attacked in the Strait of Hormuz shortly after the U.S. extended its Iran ceasefire, investors should watch oil volatility. We also need to monitor potential knock-on effects for Canadian exporters. For your own portfolio, this means staying alert to second-order moves in energy and export-sensitive names inside your TFSA or RRSP. While macro volatility is rising, one defensive framework is helping certain software franchises stay ahead of AI disruption. That framework is AI complementarity. Instead of assuming AI will cannibalize traditional software revenue, the approach identifies companies explicitly designing AI to augment core products. This expands total addressable market while defending existing moats. Today's conditions make this relevant because multiple AI-themed suppliers are guiding higher on tool demand. Yet broader SaaS stocks face skepticism about replacement risk. To implement, scan earnings transcripts and guidance for explicit language on integration versus replacement. Then cross-reference with free cash flow margins. You can do this on Canadian platforms like Questrade by pulling the latest filings and earnings call transcripts. Allocate via individual names or thematic ETFs inside your TFSA or RRSP. Historically, this framework performed best from 2015 to 2018 when cloud computing was feared to destroy on-premise software, yet ultimately expanded spending. The key discipline is sizing positions so that even a 25% valuation haircut on the bet does not breach 5% portfolio risk. Risks include faster than expected disruption that compresses multiples by 20 to 30% if complementarity fails. This approach turns AI from a threat into a moat protector when executed with care. No new practice investment today. This is a simulated exercise for learning purposes only. Current screens show setups in restricted sectors such as tech and precious metals. Others rely on lesson tags currently in cooldown. We are watching healthcare names with strong first quarter momentum and consumer names exposed to private label rotation. We are also monitoring energy volatility tied to Hormuz developments. None of these meet the full criteria of a fresh analytical approach, allowed sector, and non-duplicative story coverage. This no-trade discipline preserves capital for higher conviction setups. It also prevents sector creep beyond our 30% cap. We will target an industrials or financials name for next Monday's weekly hold, once a catalyst aligns with permitted tags. Patience in the absence of edge is itself an alpha-generating skill. Yesterday, we exited a flash trade in CLDX. This was an analyst upgrade play on successful Phase 3 results and accelerated enrollment. Entry was at $35.79 at market open. Exit was at $34.38 at market close. The simulated result was a loss of 3.94%, or $39.40 on a $1,000 notional position. Even when a binary catalyst such as accelerated enrollment is publicly confirmed, the market can still price in expectations ahead of the announcement. This is especially true when broader sector momentum is absent. The absence of verified real-time order flow led to the exit on the news. Rule: verify data availability from multiple providers before declaring a weekly hold closed. Two modern tools can give Canadian investors an information edge right now. First, Hive's managed platform powered by Red Hat OpenShift simplifies migration to containers and virtual machines while being explicitly AI ready. This lets investors track which mid-market companies are accelerating modernization at lower cost. It surfaces early signals of margin expansion in IT services before they appear in quarterly results. Canadian investors can access related company filings and sector ETF flows via Wealthsimple or Interactive Brokers. The free Red Hat Developer Sandbox lets you test containerized AI workloads yourself to understand adoption barriers. Second, OpenAI's new cyber offering briefed to U.S. agencies and Five Eyes partners creates a concrete monitoring opportunity. The edge comes from front-running procurement cycles that typically follow such briefings by 60 to 90 days. Access the underlying research via public contract databases and pair it with free sentiment scanners on TradingView. Both tools are ideal for TFSA portfolios seeking non-correlated exposure in IT services or defense tech. RBC Capital raised its United Health price target to $400 on strong first quarter results. This highlights resilience in U.S. healthcare spending even amid policy uncertainty. Consider adding to core healthcare in your RRSP if it holds above its 20-day moving average on Friday close. Citizens cut its Blackstone price target on rate and deal flow volatility concerns. Reduce financials exposure by trimming if portfolio weighting exceeds 4% until the volatility index retreats below 18. Reckitt stock dipped as first quarter sales fell short on Europe drag and a soft cold and flu season. Stay on the sidelines for new consumer staples over-the-counter positions until second quarter guidance clarifies the margin picture. Bank of America released analysis showing accelerating private label gains in packaged foods. Rotate 2% of consumer exposure toward beneficiaries or discount retailers before the next CPI print. Our simulated portfolio has completed 11 trades. The win rate sits at 27% with 3 wins, 4 losses, and 4 break-even. Cumulative profit and loss is negative $41.56. Average return per trade is negative 0.38%. Our AI analysis is learning from these outcomes and adjusting parameters around catalyst confirmation. This remains a learning journey rather than a track record to copy. Now here is something that most retail investors get wrong about tariff refunds in registered accounts. Imagine you bought 1,000 shares of a small Canadian industrial exporter in your TFSA 6 months ago at $18.20. U.S. tariffs were compressing margins by an estimated 180 basis points on roughly $2.4 million of annual shipments. With today's refund program, that same company could reclaim 70 to 90% of duties paid. This potentially adds $140,000 to $180,000 in cash, but only if it meets narrow eligibility criteria and completes a multi-step filing. Refunds lag 4 to 9 months, and the market may price in only 40 to 60% of the net present value on announcement day. A strengthening Canadian dollar can offset 30 to 50% of the cash benefit inside a registered account. The biggest mistake is treating every Canadian exporter as equally positioned. Always quantify the potential cash windfall as a percentage of enterprise value. Confirm filing readiness in the latest management discussion and analysis before adjusting position size. This asymmetric information and patience on cash timing is where the real edge lives. Before we wrap, watch for continued oil volatility tied to Hormuz developments and any healthcare momentum names that clear volume filters. That's it for today's Modern Investing Techniques. The resources page has links to everything we discussed. Subscribe and share with someone who wants to go beyond index funds. See you tomorrow. This podcast is curated by Patrick, but generated using AI voice synthesis of my voice using ElevenLabs. The primary reason to do this is I unfortunately don't have the time to be consistent with generating all the content and wanted to focus on creating consistent and regular episodes for all the themes that I enjoy, and I hope others do as well.